All right, let's jump right in. The market is absolutely soaring, but so many of us are looking at our own accounts and just not seeing the same results. In this breakdown, we're going to get into the single biggest reason why that happens, and more importantly, the one core principle you can use to completely flip the script.
This is the million-dollar question, isn't it? It is so frustrating. You see the headline screaming about a historic bull run, but then you log into your broker's account and it's just a sea of red. It makes you feel like you're missing something huge, like you're playing the game all wrong. But what is it?
Well, first things first, if you feel that way, you are definitely not alone. Not by a long shot. There was this huge study in Korea that looked at over 200,000 investors during the massive 2020 bull market, and what they found was just staggering. A full 42% of them, think about that, actually lost money in one of the best markets in recent memory. So this isn't just about you. It's about a deep psychological trap that affects pretty much all of us.
So, it turns out the biggest thing standing between you and your profits isn't the market. It's the weird wiring inside our own heads. Let's take a look at some of the dangerous mental traps that we all fall for.
Let's start with a quick thought experiment. This comes from a Nobel Prize winning study. So imagine you get to choose a prize. Option A, I hand you $30,000, guaranteed. It's yours. Option B is a bit of a gamble. You've got an 80% shot at winning an even bigger prize, $40,000, but there's a 20% chance you walk away with zero. What do? What's your gut tell you?
If you chose A, the sure thing, you are right there with the vast majority of people. In the actual experiment, most people took the certain cash. Now, what's interesting is that the gamble, option B, is actually the better bet on paper. It has a higher expected value. But we don't care. We overwhelmingly prefer to lock in a sure profit. It shows that by nature, we are risk-averse when it comes to gains.
Okay, round two. We're going to use the exact same numbers, but we're going to flip the script. Now you have to pay a fine. Option A is a guaranteed $30,000 fine. You just have to pay it, a certain loss. Option B is a gamble. There's an 80% chance you have to pay an even bigger fine, $40,000, but there's a 20% chance you get lucky and pay absolutely nothing. So, what's the move now?
And this is where our brains do a complete 180. It's fascinating. When faced with a guaranteed loss, most people suddenly become gamblers. They choose option B. They'd rather risk a bigger loss for that small chance of avoiding any loss at all. Isn't that wild? When it comes to losing, we suddenly become risk-seeking.
And there's a name for this psychological quirk. It's called loss aversion. Basically, the pain of losing $100 stings more than twice as much as the joy you get from gaining that same $100. Our brains are just hardwired to avoid pain, and in the investing world, that means we will do some really irrational things just to avoid making a loss official.
So how does this actually play out in your portfolio? Let's do one more quick experiment. You've got 4 stocks, and for whatever reason, you have to sell one today. You've got a big winner, that's up 20%, a small winner up 10%, a small loser down 10%, and a big loser down 20%. Which one are you selling? Well, the results are pretty darn clear. In the study, 65% of people chose to sell one of their winning stocks. And why not? It feels good, right? You lock in the gain, you get that little dopamine hit, you feel smart. But what did they do with the losing stocks? They held on for dear life. This is called the disposition effect. We are literally disposed to sell our winners way too early and hold on to our losers for way too long. Now, you've probably heard the classic advice, cut your losses short and let your winners run. Sounds disciplined, right? It sounds smart. But what if that advice on its own is actually just another trap that doesn't get to the heart of the problem?
Okay, this is it. This is the crucial pivot point. We have to completely reframe how we think about this whole thing. Investing isn't about watching squiggly lines on a chart go up and down. It's about owning a piece of a real, living, breathing business. And that single shift in perspective, it changes everything. This analogy just perfectly nails the flaw in our thinking. The fact that a stock's price went down, well, that only tells you about the past. It says absolutely nothing about the future. Selling a good company just because the stock is in the red is as crazy as dropping a class you love just because you bombed one quiz. The real question is always, do you think you can pass the final exam? And that brings us to the core solution, the master skill of all investing. It's learning to separate a company's day-to-day, often chaotic stock price from its long-term fundamental value.
I promise you, they are not the same thing, and the market gets them mixed up all the time.
This slide lays it out perfectly. On the left, you've got the trapped investor. They are obsessed with the past, the current price, whether they're up or down, and they make decisions based on emotion. But on the right, that's the successful investor. They're always looking forward, focused on the fundamental value of the business, and making decisions based on cool, calm analysis.
So let's just make a new rule right here, right now. It's simple, but it's so powerful. The stock you should sell is never the one that's down. It is always, without exception, the one with the worst prospects for the future. And that's true whether it's currently showing a profit or a loss in your account.
The investing world is just filled with so much confusing, contradictory advice. Cut your losses, buy the dip, it's all just noise. Instead of trying to juggle a dozen different rules, what you really need is a single, unbreakable principle to guide every single decision you make.
And here it is, your new investment principle, in 3 simple steps. Number 1, always analyze the value of the business, not its daily price. Number 2, focus on its long-term growth potential, not the short-term market noise. And number 3, this is the most important part. You only act, you only buy or sell when your assessment of the business's fundamental value changes, not when its price does.
This quote just sums up the whole philosophy perfectly. It's all about detaching your decisions from the emotional baggage of what already happened. Don't sell a stock just because it's down and it hurts to look at. And don't hold a stock just because it's up and it feels good. The only question that ever matters is this: based on what I know today, is this the absolute best place for my money to grow in the future?
And that really leaves us with one final big question for you to think about. Take a hard look at your own portfolio, at the decisions you've made. Are they acts of regret about the past? Are they driven by a fear of realizing a loss, or a fear of a gain slipping away? Or are your decisions a clear, rational vote of confidence in the future value of the businesses you own? The answer to that question will change everything for you. Thanks for tuning in.